Chances are you have both a checking and a savings account at your bank or credit union. But do you know what makes these two types of accounts different? Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. I'm Andrew Shear, and managing your money in the most effective way possible all starts with the proper use of both a checking account and a savings account. Today, I'm going to highlight the key differences between these two essential accounts and give you my advice for how to use each. Make sure you stick around until the end of the video when I'll touch on 3 other types of bank accounts you should become familiar with. Do me a favor and give this video a thumbs up. And if you're new around here, hit that subscribe button. You're about to learn something new about money. The primary differences between savings and checking accounts have to do with how you access your money and earn interest. Let's start by talking about access. There are a bunch of different ways to access money you have stored inside a checking account. You can stop by your bank and withdraw it in person, get it at an ATM, use a debit card, or write a check. And as long as you've got the funds, you can generally process as many transactions as you want. When it comes to savings accounts, the story is a little bit different. You can still withdraw your money by stopping by your bank or at an ATM. You might even be able to transfer that money over to your checking account using your bank's website or app. But with a savings account, there are no debit cards or checks. On top of that, there's usually a limit to the number of transactions you can process every month. Typically that limit is just 6 transactions, but rules are constantly changing, so you should check with your bank to be sure. Clearly, savings accounts have some serious disadvantages compared to checking accounts when it comes to accessing your money. So what is it that makes savings accounts worthwhile? Well, money in your savings account typically earns a little bit of interest. If you've got a fairly substantial amount of cash in a savings account, you might be able to earn 10 or 15 bucks per month just by letting it sit there. That kind of money is not going to make you rich, but at least it'll pay your Netflix bill every month. Checking accounts, on the other hand, earn very little, if any interest at all. Because you're less likely to constantly be depositing and withdrawing money from a savings account, banks can make a few bucks by loaning that money to other customers and charging interest. Does this mean you should worry about your bank losing the money you have in savings? Of course not. You can still withdraw or transfer any money stored in your savings account at any time. But because you're less likely to be doing so on a regular basis, your bank can feel more comfortable lending it out. That's why you'll earn some interest on the money in your savings account. It's worth mentioning that these differences don't always hold true. For example, you might come across something called a high yield or high interest checking account with an interest rate that's comparable to savings accounts at other banks. This is pretty common now, especially for online banks. Because these banks have fewer expenses than traditional brick and mortar banks, they can pass some of their extra profits along to you, the customer. If you can manage to do your banking without visiting a physical location, an online bank could be a great option. You could earn some solid interest on money in your checking account, and even more on money in your savings account. It's also worth mentioning that no matter which type of account you store your money in, it'll be insured by the FDIC if you're with a bank, or with the NCUSIF if you're with a credit union. So in the unlikely event that your financial institution goes out of business, you're covered for up to $250,000 of deposits. If you need to keep more than $250,000 in the bank, you can open accounts at multiple banks to stay under the limit. But I wouldn't recommend keeping anywhere near that much money in the bank. You would stand to lose a lot of value due to inflation. No matter where you're doing your banking, the best use of a savings account is for saving and storing money, while the best use of a checking account is for spending money. I've got both a savings and a checking account open at my local credit union. I have my paychecks deposited into the checking account, and I also pay all of my bills using the checking account. In my savings account, I store my emergency fund as well as any additional money I'm saving up. Right now I've got some extra cash in savings that will eventually go toward a down payment on a home. When you're evaluating different banks or credit unions for their checking and savings accounts, You want to find one with no monthly fees, no minimum account balances, and a good interest rate on savings. In my experience, the best place to do your banking is at a local credit union. Online banks are a close second. In addition to checking and savings, there are 3 other types of bank accounts that you should be aware of. The first one is a money market account. This type of account is kind of like if a checking account and a savings account got married and had a baby. Money market accounts typically earn more interest than savings accounts and allow you to conduct transactions using a check or debit card. But you're limited to a small number of transactions per month, and there's typically a high minimum balance required. I made an entire video dedicated to money market accounts, and I'll leave a link down below. The second type of account to be aware of is called a cash management account. This one is a lot like a savings account, but instead of it being at a bank or credit union, it's at an investment brokerage. Cash management accounts, similar to money market accounts, combine a lot of advantages of traditional checking and savings accounts. If you're doing a lot of investing, it might be a good option to look into. Last but not least is your good old certificate of deposit, or CD. This type of account is like a savings account that earns more interest but has more restrictions. When you deposit money into a CD, you promise your bank that you won't touch it for a specified period of time. That period of time would be as little as 3 months or as much as 5 years. In exchange for your patience, you'll earn a lot more interest than you would if it was just sitting in savings. The longer time period you commit to, the more interest you'll earn. CDs are not a good place to store your emergency fund because you can't predict when an emergency will come up and you'll need that cash. So aside from that, if you know for a fact you won't need access to some of your cash for a certain period of time, you may want to look into a CD. But for money you're not planning to use in the next 3 to 5 years, you'll be much better off investing in something like an index fund. What types of accounts do you have with your bank or credit union? Let me know in the comments. If you enjoyed this video, you'll love my video where I go more in depth about money market accounts. You can watch that one by clicking right here. And if you're not already a PPF subscriber, then click right here. Thanks for watching. I'm Andrew Scheer, and I'll see you next time.